let's move on to client retainers. So a client retainer is used whenever we receive a prepayment from a customer that is being served as a down payment, as a deposit, or a retainer that is then going to be used to pay invoices that are due for services that will be rendered in the future. There's actually three ways to record this retainer, deposits, or down payments. One is we can use the deposit method. Two, we can use the accounts receivable method or the negative accounts receivable method. And three, we will use the earned income method. Now, why do we need to choose one of the methods, and why is it important for us to go this route? So number one, if we got a sales tax requirement. So for example, let's say that in your state, you can only remit sales tax when the product has actually been delivered. Then you don't want to pre-invoice that sale until you actually deliver it. So it will require you to receive a payment up front and use one of these methods to record that prepayment before you actually create that invoice. So again, we're receiving a payment before an invoice is being created. We could also have the other way, where you can have a state where it doesn't matter if you were prepaid and you haven't delivered. As long as you get paid, then you owe the sales tax. Then in that case, you would actually create the actual invoice when you get paid. So that's really up to you. The other piece that could happen is sometimes you will get paid from using another system that settles all the payments with your customers. And maybe the timing in which you're creating invoices and the timing in which you're recording payments is so far apart, whether the payments are happening up front or not, it's just much easier to use this prepayment account. Also, materiality is important, right? For some folks, using recording these prepayments could have a significant impact on the net income. So that's also really important. And there's a lot of maintenance that goes in the process of keeping track of these prepayments. So also consider client capability. So if your client is not committed to doing this in QuickBooks with high level of detail, they may want to think about using something much simpler like the negative AR method, or just creating the invoice ahead of time. Now, you want to record your invoice when the income is earned, when the services have been delivered, rendered, and when the products have been shipped or delivered. So that's why it's important to separate the timing of payments with the timing of actual earned income, which is why a payment and an invoice may have different dates, and a payment could have a date before an actual invoice. Anyway, let's start with the deposit method. So with the deposit method, we would actually set up or enable the deposits button. And what deposits will do is it will open a box inside of an invoice where you can create the invoice and put in there that you were paid beforehand. Now, this is only useful when you're invoicing right when you're getting paid the original deposit. Only useful for that. And your income is going to be recognized immediately. So you only really want to use this for an occasional deposit. This is not going to solve the problem of timing of getting paid up front and delivering the products or services later and posting that income for later. So this is just simply to record an invoice and record an immediate payment upon that invoice, or a partial payment upon the invoice. This is simple. This is easy. Most people understand this, but your invoice is going to be created on the exact same day that you receive that deposit. That may not be what you're trying to achieve. Now, if you are going to receive a payment before an invoice exists, then what you want to do is you want to just receive the payment under the negative AR method. Just receive the payment, don't apply it to any invoices. This is going to create a negative balance on your accounts receivable, or a credit balance on the accounts receivable. And then in the future, once the work is performed, you will enter that invoice, enter those charges, and then you're going to match that old payment with the invoice, and then possibly apply a balance at the end to balance out that income account. At the end of the year, any negative balances to accounts receivable can be classified as unearned income if you want to clean up your balance sheet and not have any negative AR. So let's do an example of this one, because this one's really important. So we'll start with the simple concept that a customer paid us up front. So I'm going to go to receive payment, and then I'm going to select my customer. And let's say our customer paid us back on May 1st and it paid us $10,000. Now you will notice that you get a warning saying, hey, you don't have any open invoice. Maybe you're not supposed to be receiving a payment. But again, we know what we're doing. We're actually using the negative accounts receivable method, and we want to record the $10,000 because we just got paid, but we haven't delivered any products or we haven't rendered any services. So I'm going to click on Save and Close. And then I'm going to run an accounts receivable report or a balance sheet so we know exactly what's going on. So I'm going to go to Reports. I'm going to run a balance sheet, and then I'll backdate this balance sheet to May 1st. I'll just do all dates here. And then we're going to see our accounts receivable. I'm going to change this report now to accrual basis. And then we're going to see our accounts receivable. There, it's in negative. I'm going to go ahead and click on that. And you're going to see that there's all sorts of things happening in this account. We have negative numbers, positive numbers. As you can tell, there's my negative accounts receivable, that payment that we received that doesn't have an invoice. That is affecting my balance negatively. Now, of course, in my accounts receivable account, I have all sorts of numbers there, so you can't really isolate it that easily. But if I go to Reports and then I run a balance by customer summary report, so I'm going to click on Customer Balance Summary, you're going to see that our customer corp has a negative balance of 10,000, and that's by design. So I do want to owe that customer 10,000 because they paid us and I haven't rendered any services yet. Now, when it comes down to creating the invoice in the future, let's say that now we've done the work. I'm going to go ahead and create the invoice. I'll select my customer, and let's say that I'm going to charge them $21,000. Okay, and that's going to be later on in the future, let's say the 29th of May. And now that has a balance of 21,000. From this screen, I cannot apply the payment. That's the only bad thing. That's not something we could do from the screen. So I'm going to go ahead and click on Save and Close. And then I'm going to click on Receive Payments. So I'm going to click on the Quick Create button, then Receive Payments. Then I'm going to select my customer. And let's say my customer has not paid me the balance yet. All I want to do is I want to apply the $10,000 to it. So I select the invoice and then select the credit. So I'm going to select the credit for 10,000, select the invoice, and then go to payment here and just put 10,000. That way the actual balance of the payment received is zero, because we're actually not receiving a payment. We're just matching or applying the previously unapplied payment with the invoice that was created later on in the future. So I'm going to go ahead and click on Save and Close. So now my running balance should now be $11,000 positive. So the customer owes me now. So then later on, when my customer owes me that balance, I would receive a payment on some other date. Let's say this happened on June 8th, right? Some other date in the future. And then we receive the customer, and everything else forward will follow regular workflow. So that would just be a regular receive payment against the balances. But it was the original 10,000 that we wanted to record using the negative accounts receivable method. Let's move on to the third method, which is my favorite method, although it's got a lot more work involved to it. But it is my favorite in terms of setting up the correct accounting process. Anyway, most accountants would actually prefer this method because it represents the information much better. First step is you have to create a new other current liability account in your chart of accounts called retainer or customer deposits or prepaid customer income or unearned company income, customer income, something like that. Then we're going to create a service item with a similar name. You can call it retainer. And then we're going to map the account to hit the same liability account that we just created in our chart of accounts. Then we're going to create an invoice using that item to recognize that prepayment amount that we received before we've actually earned any income or before we have actually delivered any services or delivered the product. And then in the future, once we create that invoice, we're going to record all of our current items like a normal invoice. And then we're going to add as a negative dollar amount in that invoice that new retainer item. And that's going to serve as an application of the payment that was previously made. And that needs to be a negative amount in order to reduce that invoice to either zero if it's being paid in full, or to the total dollar amount that needs to be applied, and then leave the balance there for the rest. So let's do an example of that. So let's start by going into the chart of accounts, and we'll create a new account called customer deposits, and that's going to be a other current liability account, and we're going to call this one customer deposits. Again, you can call it unearned income, you can call it retainer, you can call it customer deposits. All of these will work. I do want to add the word liability next to it, so it's just very clear that that's what we're doing. We're recognizing a liability when we're receiving that retainer from a customer, and then we'll click on save and close. So we should have our customer deposit liability right here. Okay, notice that I had another account in there, but we're going to ignore the one that says customer liability. We're going to look at this one called customer deposit liability. That's the one that we're going to be tracking. Then I'm going to go into my products and services, and I'm going to create a new item. We can make it a service item, and then we'll call this one customer deposit, and we make sure that this account is hitting our customer deposit liability account. And it's a little bit counterintuitive because it's saying, what is the income account? This is not an income account. This is a liability account. But again, we're using this item to recognize that prepayment. Okay, we're going to go ahead and click on save and close. And then I'm going to use big dollar amounts here so it really stands out on the balance sheet. I'm going to create a new invoice now, and I'm going to select a new customer. Well, I'll pick the same one, customer corp. And then let's say, for example, that for this customer, I'm going to receive at the beginning of the month. I'll create a new customer just so we don't confuse. We'll call it customer corp 2. Okay, so whoops, where's my customer corp 2? There it is. And then let's say at the beginning of the month of May, we receive a deposit. So we're going to select our customer deposit, and we're going to select $100,000. So let's say that's our deposit. That's our prepayment. So the customer paid us $100,000. We're going to follow the regular workflow, create an invoice, call it customer deposit, click on save and close. We're going to receive that deposit. So we're going to follow the workflow accordingly. Nothing really changes in the workflow. We received the $100,000 that we invoiced our customer, and we click on save and close. Now we're going to go into our balance sheet. Just go to a regular balance sheet, and let's do that all dates. And let's pick an accrual report, because this stuff will only show in accrual reports. And then we're going to notice that there's a customer deposit liability for $100,000. That's exactly where it is supposed to be. Now, if I wanted to know what that $100,000 was, I would click on the $100,000, and I would see multiple transactions in there, because I could have received another retainer or another prepayment from an entirely different customer. And let's try it. Let's leave that screen open here. And I'm going to go to invoice, and I'm going to invoice another customer altogether. So I'll pick here AAA Towing, and I'm going to receive a deposit. And let's say for them, it's going to be $215,000. And I'll click on save and close. Okay, I'm going to click on run on the report, and we're going to see that both dollar amounts accumulate in that detail. Now, if I wanted to group it to know the total, I would go to group by and go group by customer and click on run, and that's going to group them together. And then when I start applying to those amounts, you're actually going to see that calculated on the report. So I'm going to leave this report open here so we can look at it right after I create a transaction. I'm going to duplicate this tab here, and then I'm going to go ahead and invoice. I'm going to create the invoice for the future, in which I'm going to apply part of that retainer. So again, I'm looking at the report here, and I know exactly how much money each of my customer has. So now I'm going to create an invoice. Let's go to create invoice. I'll pick my customer. Okay, and let me go ahead and now charge him for $63,000 worth. Okay, extra zero there, $63,000 worth. And then I'm going to use, again, this is now in the future, after we've actually rendered the services and the customer has $100,000 on account. Unfortunately, there's no warning here letting you know that it's sitting there somewhere. You have to have looked at this report beforehand to know that the customer has a balance. So that part is a manual process itself. Then we're going to put here deposit, and then we'll put here negative 63,000. So we'll do negative 63,000, and we can put here applied deposit from 5/1, whatever we want to put there really. And then we're going to click on, there's an extra 0 there. So we're going to click on save, make sure the invoice zeroes out. So now the invoice is pretty much paid, right? There's no open balance. It's now applying the 63,000. When I go and close that and go back to my report, I can click on run report, and now I can see that my customer Corp 2 actually has a balance of 37,000 because I applied that. So when I go in my balance sheet, my total is 252, and I can actually see the exact breakdown composition of how this works. Now, let's say, for example, we have another invoice that we're going to generate for that same customer. So let me come in here and let me create the invoice. And that was a customer Corp 2. And then let's say this invoice is for 50,000. So we got an invoice for 50,000, but we would have to check the report that the client only has a balance of 37,000. So when I come in here to do a deposit, this time around, I have to limit this to 37,000. Okay, if I put any bigger dollar amount, the invoice is going to show paid, and it's not because the customer doesn't have that balance. Now giving me an accounts receivable money that's owed by a customer for $13,000. So let me go ahead and click on save and close. Now when I go to my report, refresh it, see that I have now 0 in that retainer. Okay, let's say that the next month comes in and the customer gives me another retainer. So I'm going to come in here and go to invoice. And this is very common practice for marketing agencies that receive monthly retainers. I'm going to bring this up to June. And let's say now they're going to pay us 100,000 again. This happens in June, 100,000 again. There it is. And then we're going to go ahead and click save and close. Okay. So now I have, let me just run the report again by customer. So now that customer still has a balance of 100,000. Now in parallel, I need to run a report that shows me my balances by customer. And I need to make sure that I don't have any open balances for a particular customer that's on my retainer account. And that effectively is the case, right? Right now, this customer has the $100,000 from the retainer that I just invoiced and the $13,000 from the other open invoice. So if I click on that, I've actually see that I got a $13,000 open balance from the other invoice and the invoice for the retainer I just received. So normally, because I just invoiced 100,000, I would receive my normal payment for this customer for the 100,000 that I just invoiced, right? So that would happen as normal, and that would follow the normal workflow on June whenever I got paid. But the problem is that I still have an open balance for 13,000. So what I must do whenever I go into my retainer report and I know that the customer has a balance in that retainer report, I must actually go back to that open invoice and I have to modify it. I have to come in here and type another deposit, and then I'm going to put here applied from 06/01/18 deposit, and then maybe the top one I should have added a similar comment, right? That way the customer knows exactly what is being applied. And so the first one was applied from the May 1st deposit, and the second one is being applied from the June 1st deposit. So I'm going to put the negative 13,000, and then that's going to zero out my invoice. Click save and close. So when I go back into my report, run the report, I should now see the proper $87,000 balance for that retainer. So it does get pretty tricky when we talk about retainers like that. It does get pretty tricky because you have to ongoingly, you have to keep track of what's on that balance sheet account and what's on accounts receivable, and you have to always go back and apply that negative amount to that. So those are the three methods for handling prepayments from customers, or unearned income from customers, or retainers from customers. Now, this last one is a similar method to track prepayments, but instead of just concentrating on the total dollar amount, we're also going to track the sessions, or the quantity of sessions that are going to be pre-sold. So the situation is a client sells possibly multiple sessions of services, and it's often at a discount, right? Because the customer's paying them all up front. And we want to track both the income that we haven't earned yet, and also the number of sessions that haven't been used yet. So then we can consume them, let's say, for example, as the month progresses. So the setup is we're going to use the same concept, where we'll have a liability account of some sort, and then the actual service items that are being created to charge against that liability. Then we're going to create a bundle so we can group them together, and the customer doesn't really get confused about what they're seeing. And then we're going to create those transactions as delayed charges, and then create the invoices to map the actual service that you're selling and map the prepayment. So we're going to do both. So let's do the example. Let's do it on the screen so we know exactly how the process goes. Let's go first to products and services, and let's create a couple of items here. So I'm going to create a service item. I'm going to do this just for our income category. So I'm going to create an account called session, and I'm going to send that just to my income account, whatever it happens to be. Just because I want to sell them in units, I want to call them sessions just to make it easy to understand. And I'm going to create a new one, and then I'm going to call this one prepaid sessions. Okay. But this one is going to go into a liability account. So I'm going to send this one into my customer liability account. Maybe I'll create an account called prepaid sessions or something like that, but it doesn't really matter what it's called. I have one already here called customer liability, and I'm going to click on save and close. So I should have both of my items there. The one sessions that goes to my income account, and the prepaid sessions that's going to go to my liability account. Then I'm going to go ahead and I'm going to create one more. I'm going to create a bundle. So I'm going to go to new, I'm going to create a bundle, and then I'm going to call this one prepaid sessions bundle. I am actually going to call it that. You don't have to. And then here under products and services, I'm going to pick my prepaid sessions item. And then I'm going to put quantity 1. That's fine. I'm going to actually choose that amount as I create the invoice. So I'm not going to click on display bundle just because I want to simplify this process. I'm going to call this here prepaid sessions bundle. Okay. And then I'm going to click on save and close. And then the reason for that is maybe I don't want to show the units or something like that in the invoice itself. So this is going to make sense, the reasons why we created an actual bundle for this. So let me create the invoice. And let's say that at the beginning of the month, I pick my customer. And then I'm going to select my bundle here, prepaid sessions bundle. And then here where it says the individual items, I'm going to put quantity. Let's say I want to sell 6 sessions at $30 each. Okay, so it's a total of 180. My customer is not going to see the breakdown. All they're going to see is a prepaid sessions bundle. Then they don't see a unit price, which is the reason why we created a bundle. So my customer doesn't see the unit price. I see the unit price, but my customer doesn't. Okay, so I can type here in the description, I can put package that includes 6 sessions. Again, I don't want to break them down at $30 a pop, because maybe my customer will try to haggle with me and say, well, I'll pay you 3, I'll pay you 4. Let's say that's how I want to sell it. One unit of $180 to the customer, but internally is 6 units of $30. So that's why we create the bundle, so we can control inside the bundle the actual items that we want to use. And then outside to the customer, they just see that description, that 1 and that 180. So I'm going to go ahead and click on save and close. And now we know that we have received 6 prepaid sessions. If I go to my balance sheet, I should now see that liability there. Let me make sure that I put this on accrual basis. That's always an issue with the reports. And I should have $180 in my customer liability account, which is the one that we're using. So I owe my customer $180 until I actually consume those. So let's say during the month, every week or so, I'm going to start consuming those sessions. So when I click on the create button, and then let's say I don't want to invoice my customer yet. So I'm going to create a delayed charge, in this case, a delayed charge. And then let's say, for example, on the first week, let's say on Friday of the first week, I'm going to go ahead and select a session. And then I'm going to put one session at $30. Then under it, I'm going to put prepaid session, just like that, at the same quantity of one, but this time it will be -30. Okay, so this is going to zero out, and then basically every single time that I want to consume that session during the week, I'm going to do this. I'm going to create my session and the prepaid session, just so both things are being evenly moved. And let me just select my customer here, which will be this one, Bedding Barn. So I'm going to go ahead and click on Save and Close. Now, when I go back into my report, because I use a delayed charge, that's not going to affect my financial statement. So let me run my balance sheet again. And let me run that in accrual basis. My QuickBooks is set up for that. It still says 180 because the delayed charge doesn't actually apply yet. Now, I'm going to go ahead and create another delayed charge. Let me just do it again. Delayed charge. Now I'm going to do it for the end of the following week. And I'll do the same thing. Do one session for $30. And then zero it out. Prepaid session for -30. Okay? Or I can do -1 and then +30. It actually gives me the exact same effect. It really doesn't matter. So I'm going to go ahead and click on Save and New. Pick the customer, of course. Save and New. And let's say at the end of the next week. And again, all this stuff is happening throughout the month. This is not like once a month you're doing this. This is all happening throughout the month, and you're recording each of these sessions or whatever it happens to be, right? The partial service that you're doing that you sold 6 for. And you're recording these as the month goes by, just so you can kind of know and understand what's going on. And let me do, let's say, one more. And that would be on the 25th. Perfect. And then that's going to be a session. So I'm doing each one. Again, replicating what I would have done every single week as a week goes by. Okay, so I got so with this, I should have my all my prepaid sessions consumed per se in a delayed charge. Let me click Save and Close. And then when it comes time to invoice my customer, again, I'm going to click Run Report again, so you can see the balance sheet has not been affected because I haven't created the actual invoice. Then I'm going to create my invoice at the end of the month. So I'm going to go to Invoice, and then I'm going to select my customer. And I'm going to say this one's going to be at the end of the month. Let's say the 31st. And then here on the right side, so you want to pay attention to the right side, we see all these charges that we had every week. They're netting to 0, which is fine because that's really what we want to do. And then we can click on Add All. So there's a big Add All button there that we would press. So we click on Add All. And then all these sessions now get converted into an invoice. Each has the service date based on the delayed charge. It's got the negative and the positive that goes with it. At the end of the day, the invoice is 0 because our customer already paid us, right? Remember, the customer already paid us 6 sessions. So this is going to bring in all my delayed charges that I used just to kind of figure out what's going on with my sessions. Then I'm going to click on Save and Close. My customer doesn't owe me anything. Then I can go back to my balance sheet and go back and check and click on Run Report. And then I'll date this on the end of the month because we did that transaction at the end of the month. And then we click on Run Report. And now we should just have a liability of 60. Now, if I actually click on that customer liability number and I group these by product or service or something like that, assuming we have more than one item, this will actually keep track of them at the item level, or it will also keep track of them at the customer level. So this will give you the ability to break down my sales by prepaid session, and then every single week or every single period that I want to consume those items, I consume them, and they stay delayed. They don't affect my balance sheet. And then when I create that invoice, I click one button, and it all gets added for me. So it is a very different system than doing it based on invoice. But this is how some service companies work. Some service companies, they want to track it per session, per week, per day, whatever it happens to be, not just per lump sum dollar amount.